Crypto trading isn't just the future, it's one of the fastest ways beginners are building wealth today. But how do you actually start? What do you need to know before buying your first coin? And what mistakes wipe out most new traders within weeks? In this audiobook, we will break down the key lessons from how to start crypto trading, from choosing the right exchanges to understanding charts, risk, and the mindset that keeps you profitable. Ever wanted to trade crypto but felt overwhelmed by all the terms, volatility, and hype? You're definitely not alone, and that's exactly why this guide exists. Stick with me, and by the end you'll know exactly how to start crypto trading safely, confidently, and in a way that sets you up for long-term success, not quick losses. Every generation has a moment when the world quietly shifts, when a new technology, a new way of thinking, a new kind of opportunity breaks through and rewrites the rules of wealth. For our grandparents, it was the birth of the stock market as we know it. For our parents, it was the rise of the internet. And for us, it is crypto, a new frontier, a digital universe, a financial evolution happening in real time. If you're listening to this, it means you're standing right at the edge of that frontier, curious, excited, maybe even intimidated. And that's exactly how every major wealth journey begins. Crypto trading isn't just another side hustle. It isn't something people do for fun. It is a financial revolution with the power to elevate ordinary people into the kind of wealth creation that traditional systems once reserved for the elite. But like every revolution, it demands understanding, skill, discipline, and respect. Let's start with what crypto really represents. Strip away the hype, the headlines, the memes, the overnight millionaires, and the dramatic collapses. And what remains is technology. A powerful, decentralized, global technology built on blockchain. A technology that doesn't sleep, doesn't wait, and doesn't care who you are. A technology that gives anyone with a phone and an internet connection access to a global market that trades 24 hours a day. Crypto is not controlled by Wall Street bankers or government regulators. It is shaped by community, utility, innovation, and sentiment. It moves with fear and greed faster than any market in history. It rewards patience and punishes arrogance. It is full of opportunity, but also full of traps for the unprepared. And here's the truth. You don't need to be a tech genius to trade crypto. You don't need coding skills. You don't need huge capital. You don't need Wall Street connections. What you need is a roadmap, a system, a mindset, a process that takes you from confused beginner to confident trader. This chapter is the doorway into that process. Before you place a single trade, you must understand why crypto is different from every market that came before it. The stock market has opening and closing bells. Forex has institutional flow. But crypto is untamed. It is open all day, all night, across every time zone. While you sleep, whales trade. While you work, news breaks. While you eat, prices can explode or collapse. This volatility is what makes crypto exciting and dangerous. Imagine this. You buy a stock in the US market, it moves a few percent in a day. It's steady, predictable, controlled. But crypto, Bitcoin can move 8% in a single afternoon. Ethereum can pump 15% overnight. Smaller altcoins can double in a day or evaporate in an hour. This volatility terrifies some people, but it creates opportunity for those who understand it. Because in crypto, opportunity comes fast and often. Let's look at a real story. In 2017, a college student from Chicago bought $800 worth of Ethereum when it was still under $100. He didn't know much. He was simply curious. By early 2018, those $800 had grown to over $9,000. But here's what matters. He didn't become wealthy because he got lucky. He didn't hold on to his profits. He didn't understand risk. He rode the emotional roller coaster until the market crashed and his gains disappeared. The lesson? Opportunity alone doesn't create wealth. Skills do, systems do, psychology does. Now consider another example. Maya, a school teacher from New Jersey. She started trading crypto in 2020 with $600. Instead of guessing, she studied. Instead of chasing hype, she learned patterns. Instead of risking everything, she mastered risk management. She didn't get rich overnight. She grew slowly, steadily, consistently. And within 2 years, she was managing a 5-figure crypto portfolio with confidence. Her success wasn't luck. It was insight, discipline, and process. That's what this audiobook will give you. Not hype, not dreams, but a path. A clear, practical, psychological, strategic roadmap designed for beginners who want to step confidently into the most exciting market of our era. But before we go further, you must understand one more truth. Crypto isn't just a market, it's a mindset. It challenges old ideas about money. It breaks traditional rules. It flips fear and greed at lightning speed. Your success here will depend less on your technical skills and more on your ability to stay calm, think clearly, and act with discipline while the entire world reacts emotionally. This is the journey you're stepping into, a journey where volatility becomes opportunity, where uncertainty becomes potential, and where the world's newest financial frontier becomes your playground. And in the next chapter, we will dive into the foundation, understanding what crypto actually is, the building blocks, the technology, the purpose. Because before you trade the waves, you must understand the ocean you're stepping into. Before you make your first trade, before you buy your first coin, and before you even open a chart, you need to understand one thing clearly. Crypto is not just digital money. It is a technology, a network, a movement, and a global shift in how humans store, transfer, and think about value. Without this understanding, you'll treat crypto like a gamble, but with it, you'll approach the market like a strategist, someone who knows why prices move, what drives demand, and where opportunity truly begins. Let's start with the core, blockchain. At first glance, the word sounds technical, even intimidating, but the idea is simple. Blockchain is a digital ledger, a record book, that is secure, transparent, and cannot be changed. Imagine writing something in a notebook, and that notebook automatically copies itself thousands of times around the world. Once something is written inside it, nobody can erase it, fake it, or manipulate it. That's what blockchain does. It gives trust without needing a bank, a government, or a middleman. Now let's talk about Bitcoin, the first cryptocurrency, the spark that ignited this entire financial revolution. Created in 2009 by an anonymous person or group called Satoshi Nakamoto, Bitcoin introduced the world to the idea of decentralized money, a currency that no government controls, a currency that anyone can send anywhere in minutes, a currency with limited supply. Only 21 million coins will ever exist. That scarcity creates value. That decentralization creates freedom. And that combination is what makes Bitcoin the digital equivalent of gold. But crypto didn't stop at Bitcoin. Ethereum came next. not as digital money, but as a digital world. Ethereum introduced smart contracts, a type of code that executes itself automatically when conditions are met. Think of smart contracts as vending machines. You put something in, and the machine returns exactly what it promised. No middleman, no negotiation, no trust needed. This simple concept exploded into decentralized finance, NFTs, blockchain gaming, and more. Ethereum became the engine powering thousands of crypto projects, and then came altcoins, the alternatives. Some were breakthroughs with real utility, others were jokes that turned into millions, and many were traps designed to take advantage of inexperienced traders. Understanding the difference between these categories is what separates traders who grow their wealth from those who lose it. Let's break it down through a real scenario. Imagine two beginners entering the crypto space. The first one jumps in without understanding anything. He buys every trending coin on social media. He panics when prices fall. He gets greedy when they rise. He treats crypto like a lottery ticket, a few lucky wins, and then a massive loss wipes everything out. The second beginner takes the time to understand the fundamentals. She learns what Bitcoin actually represents. She studies how Ethereum works. She researches blockchain use cases. When a new coin appears, she doesn't ask, "Is this going up?" She asks, "Does this solve a real problem?" Over time, she makes better decisions, avoids scams, and chooses assets with long-term potential. She isn't gambling, she's positioning. This difference, knowledge versus guessing, is everything. Crypto's volatility makes it tempting to chase fast gains. You'll hear stories of people turning $100 into $10,000, stories of coins exploding overnight. But most of those stories leave out the truth. Without understanding, those gains never last. Crypto is a market where wealth transfers from the emotional to the educated, and the more you understand what you're trading, the more control you gain. Let's explore one more powerful idea: utility. Not every crypto project has value just because it exists. Some coins secure networks, some enable smart contracts, some power decentralized apps, some reward users for participating in ecosystems, and some have no purpose at all. In the crypto world, utility drives long-term value. Hype drives short-term movement. A beginner chases hype. A professional looks for utility. Understanding utility also protects you from one of crypto's biggest dangers: scams. Projects that promise unrealistic returns, coins with no real use case, tokens created overnight just to drain money from inexperienced traders. These traps exist because crypto is open to everyone, but so is the knowledge needed to avoid them. Another foundational concept is market sentiment. Unlike traditional stocks, crypto is heavily influenced by emotion. Social media, fear, excitement, celebrity tweets, global regulatory news, they all have immediate impact. A single announcement from a US regulator can cause Bitcoin to drop 6% in minutes. A major partnership announcement can send an altcoin soaring. To trade crypto successfully, you must understand that price is not just numbers, it's psychology. This brings us to a key distinction. Crypto investing and crypto trading are not the same. Investing means holding long-term, believing in the project, the technology, the vision. Trading means taking advantage of price movements, short-term, medium-term, or swing-based. Both approaches have value. Both can create wealth, but each requires different skills, strategies, and risk levels. You will learn both paths in this audiobook. And now let's address something crucial: decentralization. The reason crypto is powerful is because it belongs to everyone. It's not controlled by any bank. There are no closing hours, no gatekeepers, no approval needed. Crypto gives power back to individuals, which is why governments react strongly to it. Understanding decentralization helps you understand why the crypto market behaves the way it does, why innovation moves so fast, and why volatility is both a blessing and a challenge. By understanding what crypto actually is, technology, decentralization, scarcity, utility, you gain a lens through which everything else starts making sense. Charts make more sense, volatility makes more sense, investor behavior makes more sense, and most importantly, opportunity makes more sense. Crypto is not just money, it's not just trading, it's a global shift, a new economic language. And now you're learning to speak it. In the next chapter, we'll take the next big step. Choosing your trading style. Day trader, swing trader, long-term holder, short-term sniper. Your style defines your strategy, and the right style will unlock a level of confidence you've never experienced before. Before you ever place a trade, you must answer a question that will determine your entire crypto journey. What kind of trader do you want to be? Not what kind of trader sounds exciting, not what kind of trader other people are, but what kind of trader fits your lifestyle, your temperament, your schedule, and your emotional rhythm. Crypto trading is not one size fits all. It is a spectrum. Fast, slow, aggressive, methodical, adrenaline-filled, or patient. Your trading style determines what charts you look at, how long you hold trades, how you manage risk, and how you grow your account. If someone chooses the wrong style, they struggle. If someone chooses the style that fits them, they thrive. Your style is your identity, and every consistent, profitable trader on earth knows exactly what type they are. Let's explore this step by step, not as definitions, but as experiences, because your style is not learned from a textbook, but chosen from self-awareness. Imagine you're someone who gets anxious holding positions overnight. You refresh the chart every few minutes. You struggle to sleep if you have an open trade. You like fast decisions, fast results, and fast feedback. If this sounds like you, you're wired for day trading. Day traders open and close trades within the same day. They love volatility. They thrive during US trading hours when volume spikes. They rely on quick setups and fast execution. The crypto market's non-stop movement gives day traders endless opportunity, but only if they have discipline and focus. Now imagine the opposite. You enjoy studying charts slowly. You prefer waiting for the perfect setup. You don't want to sit glued to screens. You're comfortable holding for days or even weeks. You like the idea of catching big swings rather than small scalp moves. If this feels more like you, swing trading may be your ideal style. Swing traders target larger price movements across multiple days. They use confirmation signals, trend follow-through, and major support resistance levels. In crypto, swings can be huge. 10%, 20%, even 40% moves in a short time frame. Now picture someone else. Someone patient, someone strategic, someone who believes in cryptocurrency's long-term future and prefers accumulating strong assets like Bitcoin and Ethereum over time. This person doesn't care about short-term noise. They care about building wealth slowly and consistently. This is the investor. Investors buy and hold long-term, sometimes for years. They focus less on charts and more on fundamentals and conviction. Investors have created some of the largest fortunes in crypto history simply because they had the patience to hold through volatility. Finally, imagine someone who thrives on rapid movement, someone who loves speed and precision, someone who wants to enter and exit within minutes, someone who treats trading like a high-performance sport. That person is a scalper. Scalpers make dozens of tiny trades, aiming for small, quick profits. Scalping in crypto is intense. The market is fast, liquid, and extremely volatile. Scalpers need sharp focus, strict discipline, and lightning-fast execution. Each of these styles has strengths and challenges. None of them is better than the others. The right style is the one you can follow consistently without emotional chaos. Your style must match who you are, not who you wish you were. Let's take a real-life scenario. Two friends, Alex and Jordan, both started crypto trading in 2021. Alex tried day trading. He jumped into trades impulsively. He stressed over every movement. His anxiety led to bad decisions. But Alex wasn't bad at trading. He was using the wrong style. Jordan, on the other hand, started with swing trading. He analyzed calmly, waited patiently, and held trades for days. His personality matched the style, and he grew steadily. Months later, Alex switched to swing trading, and suddenly his emotional clarity returned. His results improved. His confidence strengthened. He didn't become a better trader. He became the right kind of trader for himself. This brings us to something crucial. Your trading style must match your schedule. If you work full-time or study during the day trading may be impossible. You can't monitor charts continuously, but swing trading or long-term investing may fit perfectly. If you have flexible time or prefer shorter sessions, day trading or scalping may suit you better. Crypto trades 24/7, so your schedule matters more than in any traditional market. Another important factor is your risk tolerance. Some traders handle volatility well. They can watch their trades fluctuate without panicking. Others prefer clear, stable setups. Your emotional comfort determines your style. A trader who hates fast movement should not be scalping. A trader who loves action should not be investing long-term. Self-awareness is the first skill of a successful trader. Choosing your trading style also influences the tools you use. Day traders use shorter time frames like 1 minute, 5 minute, or 15-minute charts. Swing traders use 4-hour or daily charts. Investors use weekly charts and long-term fundamentals. Your indicators, your patterns, your entries, your exits, they all depend on the style you choose. Here's the final truth. The moment you choose your trading style, your journey becomes clearer. Your strategy becomes focused. Your psychology becomes calmer. Your trading sessions become predictable. Your confidence grows, not because trading becomes easy, but because you stop trying to be someone you're not. And that brings us to the next stage of your journey. In the next chapter, we'll explore the platforms, tools, and exchanges you need to begin crypto trading safely, securely, and efficiently. Because once you know who you are as a trader, it's time to step into the actual arena with the right equipment. Before you make your first trade, you need the right foundation. Just like a pilot relies on instruments, a surgeon relies on tools, and an athlete relies on equipment, a crypto trader relies on their exchange, charts, and systems. A beginner's biggest mistake is thinking all exchanges are the same. They're not. Your exchange determines your safety, your speed, your fees, your experience, and ultimately, your results. Choosing the wrong one can cost you money, time, and even your entire portfolio. Choosing the right one becomes an advantage that supports your success every single day. Let's start with what an exchange actually is. An exchange is your gateway to the crypto world, a digital marketplace where you buy, sell, trade, deposit, withdraw, and manage your assets. But unlike stock brokerages that have decades of regulation behind them, crypto exchanges vary wildly in quality, reliability, transparency, and security. This means you need to choose carefully. The first factor to consider is security. Crypto exchanges have been hacked before, sometimes losing millions of dollars in user funds. But top-tier exchanges use advanced security systems like cold storage, multi-factor authentication, and insurance protection. US-based platforms such as Coinbase and Kraken are often preferred for beginners because they operate under strict compliance standards, maintain high transparency, and prioritize user safety. Globally, Binance remains one of the largest exchanges in terms of volume, providing liquidity and advanced trading tools. But it's essential to understand the regulatory landscape in your region. Security also extends to your own habits. Enabling two-factor authentication, creating strong passwords, and avoiding public Wi-Fi during trades are basic practices that protect you from unnecessary risks. In crypto, safety is a combination of platform and behavior. Next, let's talk about liquidity. Liquidity is what makes buying and selling fast and smooth. High liquidity exchanges allow you to enter and exit trades without price slippage, meaning the price you click is the price you get. For traders, especially day traders and scalpers, liquidity is essential. Exchanges like Binance, Coinbase Pro, and Kraken offer deep liquidity, ensuring your trades execute quickly and accurately, even during high volatility. Then comes fees, something beginners ignore but professionals obsess over. Trading fees accumulate quickly, especially if you're an active trader. Some exchanges charge higher fees for instant purchases, but lower fees for limit or market orders. Others give discounts if you hold their native tokens. Understanding fee structures helps you keep more of your profit. And trust me, over hundreds of trades, that difference becomes massive. Now let's explore the tools you need, because an exchange alone isn't enough. Every serious trader uses charting platforms to analyze the market. The most widely used platform in the world is TradingView, the home of indicators, patterns, trend lines, alerts, and visual clarity. TradingView becomes your workspace, your battlefield, your decision-making environment. Whether you're a day trader or a swing trader, TradingView gives you the ability to study market behavior like a professional. On TradingView, you mark your support and resistance zones. You identify your patterns. You check multiple time frames. You use tools like RSI, MACD, volume, moving averages, and Fibonacci levels. You create alerts that notify you when price approaches your setup. This means you don't need to stare at screens endlessly. The system alerts you when opportunity appears. But there's another essential tool, a portfolio tracker. Crypto portfolios grow, shrink, diversify, and change constantly. Tools like CoinStats, CoinGecko, and Delta help you track your profits, manage your allocations, and stay informed about price movements without logging into your exchange. Portfolio tracking keeps you organized and aware of the big picture. And then we have news and sentiment tools. Crypto moves on emotion faster than any market. A single headline can move billions. A government announcement can shake the price of Bitcoin. To stay informed, traders use platforms like CryptoPanic, Twitter, X, Reddit, and major outlets such as CoinDesk. But the key is not reacting emotionally to news, rather understanding how markets respond to it. Now let's talk about wallets. If an exchange is your gate, your wallet is your vault. Every trader should understand the difference between hot wallets and cold wallets. Hot wallets are connected to the internet and are convenient for trading. Cold wallets, hardware devices like Ledger or Trezor, store your crypto offline, making them almost impossible to hack. Long-term holdings should always be kept in cold wallets. Traders, however, keep working capital in secure exchange wallets or hot wallets. This separation of funds protects you from both human error and cyber threats. Choosing your tools is also about choosing your environment. A cluttered screen equals a cluttered mind. Successful traders build clean, simple, distraction-free setups. One screen shows charts, another shows the order book, another shows news updates. The goal is clarity, the ability to make decisions without noise. Now let's bring this to life with a real story. In 2022, a trader named Luis from Miami was making consistent profits. But one day he stored a large portion of his earnings in a small, unregulated exchange because it offered slightly lower fees. Weeks later, the exchange collapsed, freezing all user funds. Luis didn't lose because of bad trades. He lost because of bad tools. On the other hand, Sarah, a trader from Chicago, kept her long-term holdings in a Ledger wallet and traded only on major United States exchanges. When volatility hit, her funds were safe, her trades executed smoothly, and her system remained intact. Her edge wasn't luck, it was structure. In crypto, your setup is your armor. Your exchange is your battlefield. Your tools are your weapons. And the better your setup, the stronger your results. And now that your foundation is being built, your identity as a trader, your understanding of crypto, your tools, it's time for the real action. In the next chapter, we'll explore the heart of crypto trading, reading the charts, understanding candles, decoding market structure, and identifying the exact patterns traders use to profit. This is where the game gets real. Before you place a trade, before you chase a breakout, before you panic during a crash or celebrate during a pump, you must learn the language of the market, charts. Charts are not just lines and candles. They are conversations. They are stories. They are the emotional heartbeat of millions of traders around the world reacting in real time. If you can read charts, you can read human behavior. And if you can read human behavior, you can trade crypto with confidence, clarity, and precision. Let's begin with the simplest but most important concept. Price is never random. It may feel unpredictable. It may move suddenly. It may shock you with violent spikes and painful drops. But every movement, every candle, represents decisions. Buyers pushing price up, sellers pushing price down, fear causing panic, greed causing overreaction, news triggering volatility, whales making moves, retail traders following emotion. That's the true market beneath the screen, a battlefield of psychology expressed through candles. This is why candlesticks matter. They are not decorations, they are data. Each candle tells a complete story: the open, the high, the low, and the close. A green candle says, buyers dominated this period. A red candle says, sellers had control. Long wicks reveal rejection. Small bodies reveal indecision. A cluster of large candles shows momentum. When you start seeing these patterns not as shapes but as reactions, the market becomes understandable. Now let's talk about time frames, the different lenses through which you view the market. Beginners often obsess over the 1-minute chart. They zoom in so close that they see noise instead of structure. Trading becomes emotional because every tiny fluctuation feels important. Professionals zoom out. They study the 4-hour, daily, and weekly charts to understand the bigger trend. Then they zoom in only for precision entry. In crypto, a market known for fast moves, higher time frames are your anchor. They keep you grounded. They help you avoid impulsive decisions. The most critical skill you will learn is identifying market structure, the rhythm of highs and lows that reveals the market's direction. An uptrend is a series of higher highs and higher lows. A downtrend is the opposite, lower highs and lower lows. Anything else is consolidation, a range, a pause before the next move. Market structure tells you where you are in the cycle, allowing you to choose trades that flow with momentum rather than against it. Imagine watching Bitcoin rise steadily for weeks. Each dip creates a higher low. Each push creates a higher high. That's a trend. Strength, demand, confidence. A beginner sees a dip and panics. A professional sees a dip and prepares for an entry. Now imagine the opposite. Bitcoin is falling. Each bounce creates a lower high. Each drop creates a lower low. That's weakness, distribution, selling pressure, fear. A beginner buys dips believing they're getting a discount. A professional waits for structure to change before entering. Understanding market structure saves you from fighting momentum, which is one of the fastest ways to destroy your account. This leads us to support and resistance, the invisible barriers that shape price movement. Support is a level where buyers historically stepped in. Resistance is a level where sellers historically dominated. These levels form the battlefield. Price bounces between them, tests them, breaks them, rejects them. Every trader in the world watches these zones. That's why they work. When support breaks, fear increases. When resistance breaks, excitement explodes. Support and resistance guide your entries, your stop losses, and your targets. Another essential concept is breakouts and fakeouts. Crypto loves breakouts, powerful surges above resistance or sharp drops below support. But crypto also loves fakeouts, quick moves designed to trap traders, only to reverse moments later. Beginners fall for fakeouts. Professionals wait for confirmation. A breakout is not real until price retests or sustains above the level. Learning the difference protects you from emotional trades and unnecessary losses. Now let's explore volume, the fuel behind price movement. Volume shows how much interest exists at a particular level. High volume on a breakout means conviction. Low volume means weakness. Imagine watching Ethereum break resistance with low volume. It might be a trap, but if volume surges, that breakout becomes reliable. Professional traders constantly monitor volume because it reveals trader participation, liquidity, and strength. In crypto, volume spikes often precede huge moves. When whales enter positions, the market leaves clues: larger candles, deeper wicks, stronger momentum. When retail panic sells during a crash, volume explodes. Reading volume helps you anticipate shifts before they happen. And then we have chart patterns, formations created by human behavior repeating itself over decades. Ascending triangles show pressure building. Head and shoulders reveal exhaustion. Flags show continuation. Double bottoms show reversal. These patterns work because they reflect psychology. Fear and greed do not change. Neither do patterns. To bring this to life, let's look at a real example. In 2021, during the bull run, Bitcoin formed a series of higher lows while approaching a massive resistance zone around $60,000. Retail traders saw randomness. Experienced traders saw an ascending triangle, a bullish pattern signaling pressure building for a breakout. Weeks later, Bitcoin exploded past $60,000 and reached new all-time highs. Traders who understood structure were ready. Traders who didn't were late. Understanding charts transforms how you trade, but more importantly, it transforms how you think. Instead of reacting, you anticipate. Instead of guessing, you analyze. Instead of being controlled by emotion, you rely on structure. Let's address one more important truth. Charts don't predict the future. Nothing does. Charts reveal probability, not certainty. They help you make informed decisions based on history, behavior, and patterns. Trading is not fortune-telling. It is probability management. And now that you've learned the language of charts, you're ready for the next step. Crafting your first crypto trading strategy. In the next chapter, we'll build the blueprint. Your entries, exits, risk levels, confirmations, and the complete system that transforms knowledge into profit. You now understand the language of charts. You see how price moves, how trends form, how patterns repeat, and how candles reveal the psychology of millions of traders. But knowing how to read the market is only half of the journey. The other half, the part that separates successful traders from inconsistent ones, is having a strategy, not a guess, not a hope, not a feeling. A clear, repeatable, structured strategy that tells you exactly what to do, when to do it, and how to react when the market behaves unpredictably. A strategy is not something you memorize. It's something you build, refine, and trust. It's your compass in chaos, your shield in volatility, your discipline when emotions try to take over. And in crypto, where prices can swing wildly in minutes, a strategy becomes the difference between steady growth and sudden disaster. Let's start with the essence of a strategy, your entry criteria. The number one mistake beginners make is entering trades based on emotions. They see a big green candle and believe it will continue forever. They see a sudden drop and believe it's the bottom. They enter because they feel pressure, fear, excitement, or FOMO. A real trader enters only when the market meets their conditions. Your entry criteria should be clear, objective, and precise. Something like this. I enter only when price breaks previous resistance and retests it with strong confirmation. Or, I enter when a higher low forms in an uptrend combined with increasing volume. This isn't guessing. This is process. This is structure. Next, your strategy needs an exit plan. Without an exit plan, even the best entry becomes meaningless. Exits are where profits are taken, losses are minimized, emotions are defeated, and discipline is proven. Your exit criteria should include profit targets, stop losses, and conditions that invalidate the trade. An example, if price closes below my structure level, I exit immediately. Or, when my target is reached and volume weakens, I close the position. Trades should not end based on how you feel, but based on rules you wrote before entering. Now let's talk about confirmation, one of the most important parts of your strategy. Confirmation is what separates a real signal from a trap. In crypto, where fake breakouts and emotional spikes are common, confirmation saves you from unnecessary losses. Confirmation can be a retest of a level, a volume spike, a candlestick formation, or a moving average alignment. It acts as your safety net, your filter against impulsive decisions. Your strategy must also include risk levels. This is the part most beginners ignore, and it's why most beginners lose money. Every strategy needs a clear rule for how much capital you risk per trade. In crypto, where volatility can wipe out accounts quickly, most professional traders risk between 1 to 2% per trade. This protects your account from emotional streaks and unexpected volatility. Your strategy is your engine. Risk management is the brakes. Without brakes, even the best engine crashes. Another crucial part of your strategy is choosing your time frame. If you're a day trader, you might use the 1-minute, 5-minute, or 15-minute charts. If you're a swing trader, you'll use 4-hour daily or weekly charts. Your time frame determines your patience, your execution speed, and your emotional stability. Many traders fail not because their strategy is bad, but because they're using the wrong time frame or their personality. Now let's talk about something few beginners think about: market conditions. Crypto has 3 major conditions: trending, ranging, and breaking. Some strategies work beautifully in trends, but fail in ranges. Some excel in consolidation, but fail during breakouts. This means your strategy must define where it works best. A breakout strategy thrives during momentum, but suffers during quiet markets. A range strategy thrives in sideways channels, but loses when volatility increases. Understanding where your strategy performs best helps you avoid bad trades. An example: during the 2021 bull market, breakout strategies were incredibly effective. But during the 2022 bear market, breakout traders constantly got trapped in fakeouts. The market changed, and traders who didn't adapt got destroyed. Your strategy must not be static. It must evolve. You must learn when to use it and when to step aside. To help you understand how strategies develop, consider the story of Jasmine, a crypto trader from Austin. She started by copying patterns she saw on Twitter. Sometimes she won, sometimes she lost. Her results were chaotic because she wasn't following a system. She was following excitement. After months of inconsistency, she built her own strategy focused on trend follow-through. She used the 4-hour chart, waited for pullbacks, confirmed with volume, and set fixed risk levels. Within months, her results stabilized. She didn't get lucky, she got structured. This chapter would be incomplete without discussing one more essential truth. Your first strategy will not be your final strategy. Every trader evolves. Every strategy adapts. Crypto changes. Patterns shift. Volatility cycles move. You grow. Your strategy must grow with you. Great traders don't cling to one system. They refine it through data, journals, experience, and mistakes. Speaking of journaling, it is the soul of strategy improvement. When you log every trade, you see patterns in your behavior and in the market. You see what works, what fails, and what needs refinement. Without journaling, your strategy is blind. With journaling, your strategy becomes intelligent, even self-improving. Let's be clear, a strategy is not about always winning. It's about winning more than you lose, and losing small when you're wrong. Even the best strategy on earth has losing trades. What makes it powerful is consistency, risk control, and discipline. Your strategy is your blueprint. It tells you what to look for, what to avoid, and how to react. It gives you confidence when the market moves fast. It keeps you calm during chaos. It transforms you from a guesser into a decision maker. And now that you have the blueprint, it's time for the next stage. The most emotional, psychological, and transformative part of your journey. Learning how to control your mind. In the next chapter, we enter the battlefield within, where fear, greed, and impulse live. and learn how to master trading psychology. You can have the perfect strategy. You can understand every chart pattern. You can analyze trends, draw zones, and predict momentum. But none of it matters if you cannot control yourself. Crypto trading is not just a technical game. It is a psychological war, and the battlefield is inside your own mind. Crypto moves faster, harder, and more violently than any traditional market. Its volatility exposes every crack in your emotions. A 5-minute candle can swing 10% and test your discipline. A sudden crash can push you into panic. A surprise pump can tempt you into chasing. Every emotion is amplified. Every decision feels urgent. Every trade feels personal. This is why mastering psychology isn't optional. It is the foundation of success. Let's begin with the emotion every beginner meets first. Fear. Fear of entering. Fear of missing out. Fear of losing money. Fear of holding a trade. Fear of being wrong. Fear of selling too early. Fear of selling too late. Fear doesn't show up as shaking hands or a racing heart. It shows up as hesitation, self-doubt, overthinking, and premature exits. Fear pushes you out of good trades and into bad ones. It destroys your ability to trust your strategy. But here's the truth. Fear only controls you when your risk is too high. When you risk a small, controlled amount, fear fades and clarity rises. Professionals aren't fearless. They just never risk more than their mind can handle. Their psychology is stable because their risk is stable. The smaller your risk, the stronger your execution. Next comes greed, the emotion that destroys more accounts than fear ever could. Greed whispers lies into your ear. It tells you to hold longer even when your target is hit. It tells you to take trades outside your system because this one feels right. It tells you to add more size because this setup is the one. Greed blinds you. It makes you forget structure. It makes you break rules. Crypto is addictive. That's the danger. Watching a coin pump in real time can feel electric. The possibility of multiplying your account quickly makes your brain crave more. But this craving is poison. The only antidote is rules. Rules protect you from your emotions. Rules lock in profits and limit losses. Rules keep you safe while greed tries to pull you into chaos. Then comes the emotion that often hides behind logic: impatience. Crypto trades 24 hours a day, and beginners feel a constant need to do something. They feel like every moment not trading is a missed opportunity. But impulsive trades are destructive. They lack confirmation, structure, and reasoning. They are emotional reactions disguised as decisions. Real traders understand something profound. Not trading is a trading decision. Patience is a weapon. Silence is a strategy. The best trades don't appear every hour, sometimes not even every day. The disciplined trader waits calmly, without pressure, without fear of missing out. Speaking of FOMO, fear of missing out, this is the psychological trap that defines crypto. A coin pumps 20% in an hour. Everyone posts on social media. Your group chat explodes. You feel the pressure. Your brain convinces you that if you don't enter now, you'll miss everything. So you buy, and the moment you do, the candle reverses. This is not coincidence. This is human psychology. Professionals sell into FOMO. Beginners buy into FOMO. The moment you learn to wait for confirmation instead of reacting to excitement, your entire trading experience changes. Another dangerous emotion is revenge trading. You take a loss. It hurts. You feel embarrassed, angry, frustrated. You want to make the money back immediately. So you jump into another trade, not because your strategy says so, but because your ego demands redemption. And that reaction usually leads to more losses. Revenge trading destroys your account because it is fueled by emotion, not logic. The fastest way to recover from a loss is not to chase, it is to stop, breathe, reset, and return with clarity. One of the most important psychological skills is detachment. Detachment means separating your identity from your trading results. A losing trade does not mean you're a bad trader. A winning trade does not mean you're a genius. You are not your wins. You are not your losses. You are the discipline behind your decisions. Detachment gives you emotional stability. It allows you to trade with neutrality, not high on wins, not low on losses, just present, just focused. Let's look at a real example. During the 2021 bull run, a trader named Alicia built a small account into thousands by catching early moves in altcoins, but she became emotionally attached to her wins. She felt invincible. She increased her risk dramatically, ignored her strategy, and started holding trades based on hope. When the market corrected sharply, she lost everything she had gained, not because her strategy failed, but because her psychology did. Months later, she returned with new discipline. She followed strict risk rules, removed emotion from her decisions, and rebuilt her portfolio. Her second rise came slower, but it was stable, controlled, and mature. Another key psychological principle is letting go of the need to be right. Many beginners chase accuracy. They want to win every trade. They want to be perfect. But no trader on earth is perfect. Even the world's best hedge fund managers rarely exceed 55 to 60% accuracy. Trading isn't about being right. It's about managing risk so that your wins outweigh your losses. The moment you stop chasing perfection, you start chasing process. And process is what builds million-dollar traders. Self-awareness is also essential. You must know how your mind reacts under pressure. You must know what triggers your emotional mistakes. You must know when you feel tired, distracted, or impulsive. A tired mind makes careless decisions. A stressed mind makes emotional decisions. A focused mind makes profitable decisions. This is why many traders create routines. Morning rituals, pre-trade checklists, journaling sessions, and time limits. Structure protects your mind. Structure builds consistency. Structure reduces emotional noise. And finally, the most important psychological truth. Your results follow your discipline, not your feelings. If you trade based on emotion, your results will be emotional, inconsistent, chaotic, unpredictable. If you trade based on discipline, your results will be disciplined, stable, controlled, and progressive. You are not here to fight the market. You are here to master yourself. The market cannot be controlled, but your reactions can, your emotions can, your decisions can. And now that your internal foundation is growing strong, it's time for the next phase, bringing everything together into real trades. In the next chapter, we will dive into executing trades step by step, managing positions in live markets, and navigating crypto's extreme volatility with precision and confidence. You've built your foundation. You understand charts, psychology, structure, and strategy. But now comes the moment that separates learners from traders: execution. Execution is where your knowledge becomes movement, where your discipline becomes decision, where your plan becomes a real position in the market. And in crypto, where price can explode or collapse in minutes, execution isn't just important, it's everything. Many beginners think trading happens when you click buy or sell, but execution begins long before that. Execution is a ritual, a process, a calm, deliberate sequence of steps that prepares your mind, your chart, your strategy, and your risk. The best traders in the world, whether they're trading crypto in New York, Forex in London, or stocks in Chicago, all follow a pre-execution process. It ensures clarity, it eliminates doubt, it removes emotional noise. Execution starts with market conditions. Before you open a position, you must look at the bigger picture. Is Bitcoin trending strongly? Is Ethereum consolidating? Is the entire market fearful, greedy, or neutral? Crypto is interconnected. When Bitcoin makes a violent move, all coins react instantly. You never trade in isolation. Your execution begins with understanding the environment. A surfer doesn't enter the ocean without checking the waves. A trader shouldn't enter the market without checking the trend. Once you understand conditions, you narrow down to your setup. Your setup is your bread and butter. The exact conditions you trade. Nothing more, nothing less. You don't chase random opportunities. You don't jump into charts that look good. You wait for setups that match your system perfectly. If your strategy requires a retest and structure, you wait. If it requires confirmation from volume, you wait. If it requires a specific candlestick pattern, you wait. Execution is patience in motion. When your setup appears, your next job is risk assessment. This is where you determine position size, stop loss placement, and take profit levels. You calculate how much of your capital is at risk. You adjust your position so that even if your stop loss hits, your account remains safe. This single step defines whether you trade with confidence or fear. When risk is calculated and controlled, execution becomes smooth. When risk is random, execution becomes emotional. Once risk is set, you move to entry precision. Entry is not a guess. It is a moment defined by your strategy. Maybe it's a retest candle. Maybe it's a breakout close. Maybe it's a rejection wick. Whatever it is, your entry criteria must be so clear that you recognize it instantly. Traders who enter early lose. Traders who enter late chase. Traders who enter on time profit. Now let's talk about order types, because this is where most beginners lose money without realizing why. A market order enters immediately, but can cause slippage in volatile conditions. A limit order lets you choose the exact price, but may not get filled. A stop order triggers automatically when price reaches a level, ideal for breakouts. Professional traders use order types strategically, not emotionally. They never rush. They never panic click. They choose the order that aligns with their setup. For example, during an Ethereum breakout, a stop order might be ideal, but during a retest, a limit order gives better control. Execution is not clicking buttons. It's choosing the right tool at the right time. Once you're in the trade, the next stage is position management. This is where your psychology meets your discipline. Once the trade is live, emotions wake up. You start imagining outcomes. You watch every tick. You panic during pullbacks. You celebrate small gains. But professional traders don't treat live trades emotionally. They treat them systematically. They set alerts. They walk away. They stick to stop loss and target plans. They don't babysit every candle, because staring at charts creates anxiety, and anxiety creates mistakes. Position management also includes the art of reducing risk, moving your stop loss to break even once the trade moves significantly in your favor. But timing is critical. Move it too early and a normal pullback kicks you out. Move it too late and you expose yourself unnecessarily. This timing is learned through experience, journaling, and reviewing past trades. Now let's talk about scaling, one of the most powerful tools in execution. Scaling in means entering a position in parts. Ideal for volatile markets when you expect confirmations at multiple levels. Scaling out means taking profits gradually, helping you lock in gains while keeping part of the position running. In crypto, scaling out protects you from sudden reversals. It reduces emotional pressure because you've already secured part of your profit. But even with scaling, your strategy's rules must guide you, not your emotions. You never add to a losing trade. You never increase risk because you feel confident. You never stay in a losing position out of hope. Execution is obedience to your plan. Let's illustrate this with a real example. In 2020, during Ethereum's run from $200 to $600, experienced traders followed structure beautifully. They waited for pullbacks. They entered at support. They exited at resistance. They let their winners run. Meanwhile, beginners chased every green candle, bought tops, panicked during dips, and blew accounts. The difference wasn't luck, it was execution. Professionals acted with discipline. Beginners acted with emotion. Every moment of execution matters, from the first confirmation candle to the last partial take profit. Your results are not determined by the market. They are determined by how well you execute your strategy within the market. The last stage of execution is post-trade review. Once a trade is closed, you analyze it. You write down why you entered, how you managed it, how you felt, and what the outcome was. Journaling turns execution into education. Every trade becomes a lesson. Every lesson becomes improvement. Every improvement compounds over time. Traders who review their trades grow. Traders who don't repeat mistakes forever. And now that you understand how to execute trades with discipline, structure, confidence, and clarity, you are ready for the next monumental phase, consistency. In the next chapter, we explore how traders transform occasional success into steady profit, and how consistency becomes a true doorway to long-term wealth in crypto trading. Every trader dreams of consistency. It is the moment when chaos becomes clarity, when confusion becomes rhythm, and when your results stop feeling random. Consistency is not about never losing. It's about winning predictably, steadily, and sustainably. In crypto, a market where prices can explode in the morning and collapse at night, consistency is the shield that protects you and the engine that grows your account. But consistency does not arrive overnight. It is earned. It is shaped. It is the product of repetition, discipline, and emotional maturity. Consistency is not something you chase. It is something you become. And in this chapter, we will explore exactly how that transformation happens. Let's begin with a hard truth. Most beginners never reach consistency because they never trade the same way twice. One day they follow their strategy. The next day they improvise. One day they wait for confirmation. The next day they chase the candle. One day they manage risk properly. The next day they bet too big. This inconsistency creates inconsistent results. A trader who changes their approach constantly can never know what works or why it works. Consistency begins the moment you commit to following one tested approach repeatedly. Not perfectly, but intentionally. Every trade aligns with your rules. Every setup follows your criteria. Every decision reflects your system. You stop treating trading like a game of chance and start treating it like a professional craft. The first pillar of consistency is routine. Professional traders follow structured rituals. They analyze markets at the same time. They journal at the same time. They review performance at the same time. Routine eliminates randomness. Routine builds mental strength. Routine creates familiarity, and familiarity reduces emotional noise. Your trading day becomes predictable, and predictability breeds confidence. The second pillar is selectivity. A consistent trader does not take every trade that looks good. They take only the best setups, the ones that fit their strategy exactly. They understand that opportunity is infinite, but capital is not. They wait. They observe. They strike only when probability is on their side. Selectivity is a superpower. It protects your time, your money, and your emotional energy. The third pillar is journaling, the habit that turns average traders into dangerous competitors. When you journal every trade, something extraordinary happens. Patterns emerge. Flaws reveal themselves. Emotional triggers become obvious. You begin seeing the difference between your best trades and your worst ones. The journal becomes a mirror that shows you truth the market hides. And with every truth you uncover, your consistency strengthens. Let's bring this to life with an example. A trader named Daniel from Phoenix struggled for months. His strategy was solid, but his results were chaotic. After reviewing his journal, he discovered something shocking. Most of his losses came from trades taken outside his strategy. Emotional trades, boredom trades, revenge trades. Once he eliminated those, his win rate rose instantly. His growth began not because he became smarter, but because he became selective. The fourth pillar of consistency is emotional neutrality. This is one of the hardest skills to master, but it is the key to longevity. A consistent trader does not celebrate wins excessively or spiral after losses. They treat each trade as one of many. They know a win does not make them invincible, and a loss does not make them incompetent. They focus on process, not outcome. They focus on execution, not excitement. Emotional neutrality keeps you steady through volatility. Now let's talk about something often misunderstood. Consistency does not mean constant profit. Even the best traders experience losing days, losing weeks, and losing streaks. Consistency means you handle those streaks professionally. You don't increase risk. You don't chase losses. You don't abandon your plan. You reduce size if needed. You take breaks. You reset. You protect your capital. Staying in the game is the first rule of winning the game. One of the most important signs you've reached consistency is clarity. You stop feeling confused. You stop second guessing. You know exactly when to trade and when to stay out. You recognize your setups easily. You avoid messy charts or unpredictable conditions. High-quality trades feel obvious. Low-quality trades feel uncomfortable. Your intuition becomes sharper, not because you're lucky, but because you've seen your patterns repeat hundreds of times. Consistency also brings something else: patience. When you finally understand how your strategy works, you stop rushing. You stop forcing trades. You stop worrying about missing out. You trust the market to give you opportunities. You trust your system to capture them. Patience becomes your advantage. While others panic, you wait. While others chase, you observe. While others act emotionally, you act with discipline. But consistency doesn't only affect your results, it affects your identity. At some point in this phase, you stop calling yourself a beginner. You stop feeling like an outsider. You stop doubting whether you can do this. You shift from "I hope this works" to "I know what I'm doing." That identity shift is powerful. It fuels confidence without arrogance. And once you reach consistency, something remarkable happens. Your equity curve begins rising gently, steadily, predictably. Not in dramatic spikes, not in emotional bursts, but in controlled growth. This is the moment where trading becomes less about survival and more about strategic wealth building. But consistency is still not the final stage. It is the doorway, the threshold to something even bigger. Because once your results become predictable on a small scale, you are ready for the next level. Scaling your capital. In the next chapter, our final chapter, we step into the world where consistent traders transform discipline into exponential growth, where small accounts become powerful engines, and where the roadmap to crypto wealth becomes real, tangible, and achievable. You've built your foundation, you've developed your strategy, you've mastered your emotions, you've reached consistency. Now you stand at the most exciting stage of your entire journey. Scaling. This is where controlled growth becomes exponential. This is where the small wins you've collected begin compounding into something meaningful. And this is where every decision you make becomes more powerful, more impactful, and more rewarding. Scaling isn't about trading more. It isn't about risking more recklessly. It isn't about trying to double your account overnight. Scaling is the art of doing the exact same things that made you consistent, but with more capital, more structure, and more intention. Scaling is evolution, not gambling. It transforms a skilled trader into a wealthy one. Let's start with the first truth of scaling. You scale only when your system is stable. You don't scale after a few lucky wins. You don't scale because you feel confident. You scale because your data, your journal, your results, your consistency proves you're ready. When your strategy has performed reliably across different market conditions, only then is scaling a good decision. Scaling begins with something simple but powerful. Increasing your position size slowly, not doubling it, not tripling it, slowly, steadily, gradually. If you've been risking 1% per trade, you move to 1.25%. After another month of consistency, you increase to 1.5. This slow approach protects your psychology. When your risk grows too quickly, your emotions grow with it. Suddenly, every candle feels heavier. Every pullback feels dangerous. Every losing streak feels catastrophic. But when scaling happens gradually, your mind adapts naturally. This brings us to the concept of emotional scaling. Many traders assume scaling is strictly mathematical, but most of scaling is psychological. The moment you start trading larger amounts, your psychology changes. A $20 loss feels insignificant, but a $200 loss feels personal. A $1,000 gain feels exciting. A $3,000 loss feels heavy. Your brain reacts differently based on the size of your positions. This is why traders who scale too fast lose everything. They aren't emotionally ready. Their skill is strong, but their mind is not conditioned. To scale successfully, you must grow both your account and your capacity for emotional control. That is why scaling slowly is not weakness. It is wisdom. It keeps your psychology stable while your capital expands. The next stage of scaling is compound growth. This is where things get truly powerful. Compounding means reinvesting your gains back into your trading account instead of immediately withdrawing them. A $1,000 account growing consistently at 5% per month becomes $1,600 in a year. But a $10,000 account growing at the same rate becomes $16,000. A $25,000 account grows into nearly $40,000. And once you hit six figures, compounding becomes explosive. Compounding is the quiet multiplier behind every seven-figure trading story. It's not dramatic, it's not exciting, but it is inevitable when consistency meets time. Another scaling tool is strategy expansion. Once you are consistent with one strategy, you can introduce a second one. Not to complicate your trading, but to diversify it. For example, you may begin with a trend-following strategy on the 4-hour chart. Later, you add a breakout strategy. Then maybe months later, you add a longer-term investing system for Bitcoin and Ethereum. Multiple strategies reduce risk and smooth out your performance, especially when the market shifts into different conditions. Next comes market diversification. As your account grows, you don't have to trade every coin. In fact, professional traders often specialize in a few assets: Bitcoin, Ethereum, or specific high-volume altcoins, because liquidity is stable and price action is cleaner. But as your capital grows, you can allocate portions of your portfolio to long-term holdings, staking, yield farming, or blue-chip NFTs. Diversification creates stability. It balances your risk and builds multiple streams of wealth within the crypto ecosystem. Let's talk about something every scaled trader must master: drawdown management. Drawdown is a period when your account decreases due to a series of losses or a market shift. Drawdowns are normal. They happen to every trader, no matter how skilled. But scaling changes drawdowns. A 5% drawdown on a $1,000 account is manageable. A 5% drawdown on a $50,000 account feels intense. On a $200,000 account, it can feel overwhelming. This is why scaled traders must be more disciplined than ever. They reduce their risk during losing streaks. They pause trading if emotions spike. They protect their capital at all costs, because large accounts require mature psychology. Let's bring this into a real-world example. Sophia, a trader from Los Angeles, started with just $700 in 2019. She built her consistency on the 1-hour chart, grew slowly, and kept reinvesting her profits. When she crossed $5,000, she scaled her position size modestly. When she reached $10,000, she switched to trading higher time frames to reduce emotional noise. By the time her account hit $50,000, she diversified into long-term holdings. Today, she trades part-time and invests part-time, her capital growing steadily, not explosively, but reliably. She didn't rush. She didn't gamble. She scaled intelligently. That's why she succeeded. Scaling also means understanding that lifestyle matters. As your account grows, trading becomes less about adrenaline and more about stability. You aren't here to gamble your way to riches. You're here to grow your wealth long-term. Many traders scale too fast because they chase luxury too soon. But real wealth is subtle. It grows quietly. It grows through discipline. It grows through repetition. And now we reach the final truth of your journey. The truth every beginner must eventually understand. The hardest part of becoming a profitable trader is the beginning. The easiest part is scaling once consistency is mastered. Everything you've learned in this audiobook, understanding crypto, choosing your style, developing your strategy, mastering psychology, executing trades, reviewing performance, staying consistent, has led you to this stage. You are no longer a beginner. You are no longer guessing. You are no longer gambling. You are a trader, someone who understands the market, understands themselves, and understands the process. And now, with consistency as your foundation and scaling as your next step, you are ready to step into your future. A future where crypto trading is not just a skill, but a lifelong wealth-building system. Now you know the complete roadmap to trading. But what if I tell you, having the knowledge of only trading will not guarantee success? Trading involves understanding the basics of the stock market to support your trading decisions. To get a complete understanding of the stock market and leverage this knowledge for your trading journey, click on the video popping up on the screen.